We have a pretty important audience today. Many different cities. I'm glad. I'm glad. All right. So I was, explaining that basically it's one of the first times that we get to introduce the audience into stocks. And I'm the CEO of Watch My Trading, and basically I'm a trader. That's pretty much what I've been doing for the last 10 years. But in particular, stocks are, kind of changing for the last 5 years, getting with a lot of volume, and it's it's pretty nice to see how the volume gets investors to start seeing the stock market in a way different strategies like it was before. And I would like to start with the concept of the difference between, stock trading and stock investing, because that's pretty much what we are here. We are traders. We're not investors. And like I said, in particular, what my trade, what we do is like we trade mainly on FX, right? So we basically trade Mondays through Fridays, especially in FX, and all year. We don't trade only when the stock market closes, basically on Christmas and New Year's Eve. Those are the only 2 days where we don't have trading sessions, as I call it. And my trading sessions are based on price action trading with the majors. And also we see the Texas oil, also gold, and on commodity side, those two only. But I'd rather go for the FX. FX has more volume sometimes than commodities. Some commodities, of course, they have pretty good volume, but FX has the best volume for intraday traders. Now, the difference between stock trading and stock investing is that we are now going to get you into the stock trading, because we don't basically invest on stocks. And, stock trading, like I'm trying to explain here, that was a strategy used on the 80s and the 90s. Today, basically the globalization and, the system is so tied up that the market doesn't go all the way up, like it used to do in the past. Today we have the cycles of the economics are pretty quick. So we experience a lot of fast market corrections on the index and also, of course, on particular stocks. And that brings volume to the market, and that brings more intraday traders to participate in the stock market as well. So stocks investing, like basically, the buy and hold strategy, it's not really common for lower capital investors, meaning that the buy and hold are more used for companies, corporations, and basically what they do is like they buy stocks twice a year and they hold it until they cash it. And, of course, it has more analysis than that, but that's basically the buy and hold. It doesn't imply that much strategy. Instead, the trading, it's more, we can say it's more fun, but also we trade on basically how can I say this? It's like we got two sides to trade on stocks. We got the CFDs and also we have the option, right? Derivatives. Yeah, it's kind of, it's not a word that I said in English too much. But what we're going to see now is the contract for difference, right? The contract for difference. Basically, at the end of the presentation, the idea is to give you an insight in how you can read the price on a very specific stock and how to take advantage from the speculation of the price. But I'm going to be focused on the contract for difference, not on the option. I only do CFDs. Options, I don't do options. I don't do binary options or cryptocurrencies or anything like that. I only do CFDs. And the CFDs of currencies, index, basic stocks, and some commodities if I see a good volume on intraday basis. Another thing to clarify here is that, you had to pick just a few stocks to trade with. And you can combine in your own investing account like many different instruments. But you have to make sure that first you understand the concept of margin and also the concept of risk and, of course, leverage. So before understanding how to pick the stock, how to read the price of any specific stock, of course, you had to go ahead and go to your broker and understand how much margin you need to trade stocks, how's the risk being used when you trade stocks, and how the leverage also works in your specific broker. Because the leverage, it's a concept that implies different, approach to the margin. Of course, margin and leverage has a tight relationship, these two concepts. And I'm not going to go through this margin, risk, and leverage, but like I said, before you invest any specific amount, I'm talking lower, like 2,000, 5,000, 10,000, 20K, those are like small investments into this market. The large investments for those above 100K type of accounts, and that implies more like a buy and hold strategy. So yeah, it's going to take me like around 40 minutes, maybe a little bit more to finish the presentation. So, and in this market, like I said, we do have two type of investors. And when you start trading, right, we have the lower ones between 2K, 5K, 10K and more, and we have the big ones above 100K. Above 100K, since you have a large amount of capital, you rather go for the buy and hold strategy, picking a good, stocks, and then just staying there for 3-4 months, and then you cash it. But of course, your entry price has to be very good, because even though if you do the buy and hold strategy, the buy entry or your buy price of the stock, it could be a bad pick. So you have to be very careful on this first, and then to see if you can actually hold it, because your entry price is a good one. If it is not a good one, then you rather have more skills and learn to trade instead of invest. And there is many strategies. I'm also going to show you some bad crises that happened on some very specific stocks, like the dot-com crisis on the 90s. There was a pretty intense crisis on the stock market, and I'm going to tell you a little bit about it. How was the bubbles of the dot-com? And to me, like for the last 20 years, that was the most important one, besides all the crises that in the stock market also. So that being said, like based on the risk situation that we have more now, often corrections in the market than before, then you rather get more skills and understand how to trade the price instead of how to invest on stocks. Especially if you are around these type of investors, like 1,000, 2,000, 5,000, 10,000. So I'm going to go ahead and explain a little bit about how different strategies work on the stock market. I'm going to start with the easy ones and then going towards the more complicated strategies. So, first of all, we have, of course, different types of stocks based on the capitalization of the company. So we have the high caps, the medium caps, low caps, and of course the penny stocks type of stocks. The penny stocks, of course, are those that cost less than $5 the stock, and those stocks, they don't trade on the major index, on the US. I'm going to talk only about the US indexes stocks, not about any out-of-the-counter type of stocks, which are the penny. Penny stocks are those, like I said, the value is less than $5, but those cannot trade on the NASDAQ, they cannot trade on the New York Stock Exchange, they cannot trade on the Dow Jones, on any of those. The penny stocks trade on the OTC type of market, over the counter, basically not regulated, kind of shady sort of, prices. Penny stocks, it was kind of like, it was kind of fashion back in the days, but today people are more skeptical to penny stocks because of course they're cheap, but most penny stocks never reach to trade on the index, on the official index, but instead some stocks that they lower their price to lower than $5 a stock, they go to the penny stock market and they trade OTC, over the counter. So many things are being said about penny stocks. Yeah, apologies for the background interferences. And, many like I said, many stocks trading on the penny stock on the OTC market, they barely make it to trade on the Nasdaq, the Dow Jones, the New York Stock Exchange, and those index. They pretty much stay on the penny stock side, OTC. So you can say, well, how the penny stock gets their prices. Well, that's the thing of the OTC market, that they don't have an official index where you can have like a regulation structure where there's a transparency about how the stocks get those prices. Is all based on traders or investors that are behind the price of the penny stocks. I can show you where the penny stocks are and where those prices you can get from, but I rather focus on the high caps, medium caps, and low caps sort of stocks instead of going to the penny stocks. Like I said, I'm also very skeptical about trading on the penny stocks because also the low volume. They don't have enough investors. They don't have enough trading volume to basically trade with. And on top of that, most brokers, they won't offer you a penny stock, in their platform. So it's something that it kind of like in a parallel world, I would say, from the stock market. So I'm going to go ahead now and start with the gap strategy. This is pretty much the easiest way to start trading on stocks. And I'm going to be focused on just the major stocks. So as you can see here, I'm naming the gap strategy. Also, there is the based on earning calendar, based on news, and also we're gonna choose, like 3 different stocks, maybe 4 different stocks, and how to trade gaps, how to trade the earning calendar, and how to trade news. So for gaps, which is the first one, give me one second here. I'm gonna find a better place. So I'm going to start with gaps. And if you are trading FX, I'm sure that you understand about gaps, but to trade on stocks, it's a different story. I'm going to show you, one of my accounts where I get to trade stocks, and I'm going to show you basically how to trade the gaps. So I'm going to Amazon first, and I'm looking at the quotes of Amazon and the opening of today. So what gaps means is when, of course, the stocks, they close and they open, right? So, any given stock is going to close when the stock market closes, and then it's going to open when the stock market opens. That's why you see these little gaps with no prices, on the stock. There's not like a line, like a sequence, as we can see on the FX or in maybe other instrument that we do have all prices every single minute. On this particular case, every trading session lasts 8 to 9 hours, then open, closes, and then you don't have the possibility to do anything until the next trading day. So this is the case of Amazon, and of course, I'm going to lower to see more activity in the stock for the last few weeks on Amazon. And as you can see, we have the lowest price on the past month. It was down below here. I'm going to put the crosshair. And it was around the 14.27, the price of the stock in Amazon. So you need first to gather information, because even if you trade the gap, you need to know what's going on with the stock in general. So what is the activity for the last few weeks? And then we see the gap and how to trade it. So let's see for Amazon. We need to have any given low price and any given high price on the stock. And I'm going to take, like I said, the last few weeks. I'm going to put a line to the low levels for the last few weeks. I'm going to find an average low on the stock. The average low on the stock, I'm not going to go all the way down to here, as you can see, which is 1431.30. I need an average. So I need to move my line a little bit up. And that gives me the 1485 price for Amazon. We're going to choose here the low levels of the price of the stock. It's going to make sense later on for you. And I'm going to put another line for the high levels on the stock, the high prices on average for the last few weeks, basically October. We can take November and also December. For December, it was the 1704 and then 1768, taking in consideration November and also October. So I need my low levels, my low prices, and also my high prices for the stock. Okay, so we got the average highs and we got the average lows. So for now, that's pretty good information. As you can see, if we see for the last few months, the stock of Amazon for August, September, October, it was dropping from the 1200, down to these lowest levels of October, November, and December. So we can say that Amazon is at a very good entry point for buyers on these levels. We can say that for now, but let's see how can we trade the gap. And for that, I'm going to make my chart bigger. And as you can see, we have the gap of the today, how the market opened. It was actually a gap down. We had two types of gaps, gaps ups and gaps down. So a gap down, of course, you pick any stock that you like, and if you see that the market closes in here, this is the close, and then it opened below, this is the open of the next day, it opened below, that is a gap down. All right. What about the opposite, that the market closed below, let's say here, and then it opened above? That is a gap up. Gap up and gap down. Can you see the difference between them, right? Gap up and gap down. Great, exactly. The time frames used to trade on intraday, let's say you are a swing trader or intraday trader, and on top of that, you are also a scalper. All right. So basically, a swing trade, what it does is that you trade the swing of the day, the market range of the day, which pretty much means the same as being an intraday trader, because you're supposed to have a swing of the day on intraday basis, holding your transaction from one day to another. You want to enter and closes in one day. Now, if you enter and close in one day, but the volume of the market is also pretty good, and you want to scalp it, so basically, you divide the swing of the day in many different transactions. That means you are a scalper. The thing of scalping stocks is that the volume is not good enough to do so. So you cannot expect the market range to be exactly from point A to point B or from point A to point B in one trading session. The volume could be kind of low, and then the market is going to move only from A to B in the middle, and then it closes. Never got to reach the target B. Market range, it's called the swing of the day, and that qualifies you to be an intraday trader. You don't want to keep or to hold transaction from one day to another. And in order to be a swing trader or intraday trader and also a scalper, you're going to be using 1 hour to 15 minutes time frame. In 1 hour is good enough to see how the market opened, how the market closed, and how is the activity of the day, right? And then 15 minutes is for you to plan the strategy, where you're going to enter and when you're going to close. So let's go ahead and see how Amazon started it today, and how you were able to trade the gap. So now we got the gap up, right? We said gap up and the gap down. Like I said, this is the most easiest way to trade, but the only disadvantage is that you have to wake up at the moment where the stocks start giving you the prices of the stock that you want to trade with. So let's say Amazon, Netflix, Disney, Apple, Alibaba, they all trade on the US stock market. So you have to wake up at any given moment to see exactly the gap that you have and then to trade that gap. If you want to trade Ferrari, for example, or any, I don't know, let's say BMW, well, you have to wake up for Ferrari and trade on Italy, hours. And you trade over the ITA 40, which is the index of Italy. And otherwise, you want to trade on the German hours, and you have to trade on the DAX index, like taking in consideration the DAX hours, which is the German index. So depending on the stock where it trades, you're going to have the prices from, you had to follow that country, right? So there's also, plenty of European stocks trading in the US market and the opposite. So not necessarily, you have to see where the stock is. I'm going to show you where you're going to find that information also. So this is, like I said, Amazon, and as you can see, it had a gap down, all right? So opposite as many traders think that the way to trade a gap is to trade against it, let me tell you, that is not the safest way to trade the gap. When you see a gap on the market, you want to trade a favor, basically on the same side of the gap. If you have a gap down, you want to sell. If you have a gap up, you want to buy. Many traders, they do the opposite. They say, okay, well, you have a gap up, so it means that the gap is going to get covered, right? So if it is a gap up, you want to sell. And if it is a gap down, you want to buy. Because those prices, people want to fill it up. And then you get to get in that gap and get into those buyers or get into those sellers. Well, today, like many other also instruments, not only stocks, the safest way is to follow the gap on the same direction, and only to trade opposite to the gap is when it fills out of 50% of that gap. So let me explain that right, because I've seen many traders getting stuck on transactions thinking that the gap is going to be filled, or thinking that just it's going to happen and never happen. So if you want to be safe trading gaps, then like I said, you have to do the same way or the same direction, trade same as gap opening. Same as gap opening. So if you have a gap down, you want to sell. If it is a gap up, let's do like this, you want to buy. The only and the safest way to trade the opposite as the gap, basically, is when you have 50% of the market already in that gap. At least 50%. I know you're going to miss like 50% of the transaction if you enter exactly at the opening of the gap, but it's not safe to do so. So you wait 50% of the gap and then you enter above the gap down to buy, or below the gap down to sell, the gap up to sell. Basically thinking that, in fact, the gap is going to be filled. So we have here, let's give an example, the market closed here, opened here. So if we think on the theory that the gap is going to be filled out, we will sell here, right? It closed, it opened, so we're supposed to be selling here. Now, that day, the market was gap up and it was all the way up. So you were losing money the entire time of that specific trading session. So you waited 1, 2, 3, 4, 5, 6, 7, 8 hours until at the end, at the closing of that specific trading session, then Amazon or that specific stock dropped to your entry price, which was here. And then finally, you got to make some profit, but probably at the aftermarket, at the closing, and maybe your broker didn't give you the possibility to close, to take that profit of that transaction or to close it. And the next day, it opened down, so there you do have a lot more profit. So think on the risks and the exposure that you have, basically selling a gap down situation. The gap was never filled out, but until the next day, because people was cashing out their profit, and then the market dropped or Amazon dropped. So If we go for the safest way, basically trading the gap up and buying, then what you're going to do is this. Of course, I need to go to 15 minutes to see it closer. And I'm going to find the specific moment where we had that gap. Because it's not that, the market opened with the gap, opened with the gap up, and you get to buy, right off. So you have this, here was the gap, and then you get ready to buy above here, basically, because the market is not filling out the gap on the first hour of the trading session. So you buy from the beginning, gap up, you buy. This is one option. The next option is to sell when you have 50% of the market dropping. So basically you have this, and then that 50% you get to sell. And that's when you get down to the opening of the price. Gap up, you sell 50%, in gap up, you buy above the opening price. And then how to see your targets, or how to see when you're going to close the transaction, that's another story. I need to see how the market react and what are the high levels on this specific stock. Let's give another example. We have here the market closed, the market opened, gap down. So the only way to do a strategy here is to buy after the 50%. So you will know, basically buying here or here. You were buying in here. So then you got to buy here, kind of a little bit more up, basically looking for that 50% of the market, trying to fill out the gap. Then the market dropped. But you're doing okay as long as the market is above the open price. Above the open price. So a drawdown is okay as long as the market is above the open price. So you had to resist basically like 45 minutes until the market started buying again, break even, target profit, the gap was 100% filled. So basically all the market that was out of the stock of Amazon, then was all filled. And you keep reading the gaps exactly like that. Don't expect the gap to be filled up. You enter against the gap if it is filled 50%. Otherwise, you go along with the gap. If it is a gap up, you buy. Gap down, you sell. The opposite direction, you wait 50% of the market first to get in. Don't get in thinking that a gap is going to be filled, because most cases it won't happen. There's another example, and you may want to practice first before trading with gaps. I'm trying to see if we have another stock with more excessive gaps. That's right. The 50% is calculated from the previous close. This is what I'm trying to say with the 50%. So this is of course, the market is already passed, so it's hard to say exactly how much, the gap was, how big the gap is. It's like, because we don't know if it is up to here or up to here. When the market is already gone from that day, it's hard to read it. But basically, gap is like, you see this amount and you calculate the 50% of it. 50 is like half of it, half of the gap. Because, for example, if the market closes here and it opened down below here, it may open here. I mean, this is the one, this is price, and also this is also price on the 15 minutes. But you need the 50% of the entire activity. 50% of your entire activity gives you there. So here is your entry price when trading on the gap direction, basically thinking that it's going to be filled out. So you wait for the gap, you take the entire market gap like empty prices, because there was not a green candlestick, there was not a red candlestick, there was not buyers when the market opened. So you were not buying from here up to here, you were buying above the 50% after the buyers got to buy 50% of the gap. This was your entry level, 50% of the gap. So you got to enter here and then scalp the range, or to do just one swing transaction and closes in here, which are your targets. You may want to close it at the opening price because that was already 100% of the gap done. Or if anything, you can, hold the transaction, hold your buy transaction and wait a little bit more until the new highs of those levels. But up until the opening price is already a great transaction. For intraday basis, trading on one specific stock is a great trade. So you want to consider that, most hedge funds, most also, funds, and they do also intraday trading, and they trade the gaps the way I'm telling you, because, of course the market doesn't have the power to say, okay, well, of course you're going to go up from here up to here, and you don't want to take that risk. So market is going to get more aggressive after the 50% of the activity, not before that. A gap down, you want to sell, and you start selling here. This is your gap, and you sell below the opening price that you see in your trading account, because many brokers may give you different hours to trade with. Some brokers may open at 8, some brokers may open at 6. Some brokers may give you after trading hours, and some brokers will not give you that. So you have to first understand the trading hours that you have available, the stocks they want to trade with. Let's go ahead and see Apple and see some gaps of Apple. So like I said before, we first need to understand the activity of the stock, even if you're trading gaps. So I want to know what happened with stocks of Apple for the last few weeks. So, okay, well then I see that the market has all this way down to 165 to 66. And it was dropping from October, from these highs, an average price of the highs. I don't need to be very specific on this, but I need to know the average of the highs. And that was that 227. And I need to know the average of the lows. Well, I have the lows of today, 165.74. But I need to also see if the market sees these levels as an entry point, because maybe it's a good opportunity for, to buy the stock and then to keep the transaction for at least a few days. And as you can see, the historical levels are telling us that information, that the market here sees a good entry level for buyers into the highs of that will be 200 and 227, the stock on Apple. So this could be also a good buy strategy for a few days, considering that the markets have seen this in the past, and we are at the lows of the year. Of course, you don't want to buy now or today, but you want to wait for at least one trading session that the market closes above the opening. That's the first insight that you need to understand, that the market is looking at the Apple stock for a buy and hold strategy. But like I said, the market now is at the very lows of the year. So let's see what I'm trying to say about the buy and hold. So we have today's activity. The market opened, the market closed here and opened here. So if you trade the gap, this for you was a sell type of strategy. So you were selling today here. A little bit of drawdown at the beginning, but nothing major. And then you close, let's say here. That was your target, because that was also the low of December 7th. So you go to sell and you close your transaction there. And then what happened? You never got the chance to buy in the gap of the 50%, because this was your gap. Let's say you have quotes in your platform starting here or starting here. So you take this as your gap. So you were supposed to be buying here, 50%. Never seen the 50%, so it was not a day of buyers. So What if it was a day of buyers, considering the opening and the closing? Well, if you have the opening here, and the opening, the close here, and the opening here, and the market closed exactly at the previous close, that was a buyer's day. Basically, all the market filled out the gap and also closed above the opening, meaning that all the market was buying on that day. All market was buying on that specific day. All market was buying on that specific day. And I hope that's clear. Let's put it like this. We have opening on point A. And then we have the closing on point B. Market open and closed. Open price and close price. So this means the market got to sell on that day. Now, if the market opened below and closed above, then that was a buy day or a buyer's day. The market opened below and closed above it. There was a buy day. Basically, all the market of that specific day saw the opportunity to buy and hold the transaction. They didn't profit from it. They hold it. They say, okay, well, it's going to keep moving up for the next day because of whatever reason, news or... So you want to consider the open price and the closing price. That gives you a lot of information also for the next day. If the market closes above the opening price, that's a buyer's day. If the market closes below the open price, that's a sell day. Or that's a day where the sellers were in control, not buyers. So, the second strategy, the first one is to trade the gaps. I can go ahead and see really quick again how to trade gaps. And this is the another strategy to trade, which is the earning calendar. The earning calendar. So what you need to know here is when Amazon is going to report the earnings. And you have between January 30 down to February 4th next year is the earning date. And then once you have that specific week, you go to the calendar specifically, and that's when you find out exactly the day that they are going to give the you got here, you go to investing, earning calendar, you click on earning calendar. This is not economic calendar, it's earning calendar. You go to earning calendar. In here, you're going to have the very specific day where the market will gives you the day where you want to report the earnings. And of course, if it is a good number, the stock should go up. If it is a bad number, the market is going to take their profit and to close the transactions and is going to drop. It's that simple, it's that easy. You can compare this as a fundamental trading, which is not really fundamental trading because you're trading the earning calendar or the earnings of that specific company. And like always, more earning than expected or better than expected, the stock's gonna go up because the traders, the investors, they don't want to cash the stocks. They want to keep it. They want to hold it. They say, okay, well they did good. It's gonna keep moving up. Of course, it's speculation. And if it is a bad number, and let's say they make less money than expected, or the revenue is less than expected, then they want to cash it. They want to cash their profit, and the stock is going to drop. And to do so, you need to, like I said, go into earnings calendar. You check the week where that specific stock is going to publish their own earning. And let's go to, well, the earnings season, I mean, the earning reports, let's go to January now. Most of them are going to be in between end of January and February. And then you check here what a specific day they supposed to publish their earnings. Typically it's at noon. You have Netflix here, for example. Netflix on January 23rd, basically, here, you have Netflix. You have, of course, all of them. But, Netflix is kind of, booming for many reasons. So let's go ahead and see Netflix, how it is right now. And then you go to Netflix. You wanna trade instead of the gap, because the gap you can trade on every single day, right? When it opens and closes, every single day you can trade the gap. Now, if you want to trade the earning calendar, it's just one specific day, so you can pretty much mix both strategies. You can trade the gap, and also you can go ahead and trade the earning day, the earning calendar on that specific day. So let's say that Netflix, we already have the date, is on January 23rd, and like I said, typically it's at noon, so around 12 Eastern time, they publish the earnings. Or it could be very early in the morning, but most likely it's going to happen after like 3-4 hours after the closing. So let's say it doesn't matter here the opening or the closing. It matters the result. That's it. That's all it matters. So let's say it publishes like around 12, and the market is already all the way up to here. You are on January 23rd, and the market it's gap up on the it's supposed to be on Amazon, here. So the market did a gap up, and let's say that you're buying in here, and then you saw like a huge spike going up, because the earning day, when they publish their earnings on that specific month, of course, it's supposed to be good. People's going to be expecting a good number. Nobody expects a bad number unless they have some commercial strategy that didn't came through, or they have like strikes of employees, and or like many things could happen, or the employees sue the company for whatever reason. Those situations, it could be to trade the news. That's your fundamental trading with that specific news. But in terms of to trade the exact day of earnings, then everyone expects to go up, not to drop. Let's say it's a bad number. So you apply the strategy of the gap, and then you say, well, I'm expecting a bad number, so I'm going to start, and if it drops to here, and then the communication of the earning comes whatever times in the morning, I'm going to be waiting to sell here, or I'm going to be waiting to buy here. You can consider the gap or not, or you can trade both. The gap at the first time in the morning, the first hour or 2 hours, and then you wait for the earning results. Today, there's also another way to trade. Yes, exactly. You trade in the direction of the result of the earning. So if it is a good number, of course, nobody wants to get out of the stock. They all want to hold it. And even more traders are going to try to buy the stock. So it's supposed to go up. And if it is a bad number, then they're going to cash out their profit, and it's going to drop. So you want to sell because you're working on the CFDs. You don't care if the price goes up or down. You can make money in both ways. You're not on the title of the stock. You're not buying the title of the stock. It's not that you expect the market just to go up. You are trading on the CFD. So you care about the moves of the price, how fast the price moves, either up or down. So there's also another way to trade stocks, and good earnings, you trade long, bad earnings, you trade short. That's exactly right. And unless something in between happened, like news, or I don't know, something could happen that even if it is a good number, it drops. Because like I said, you also have to kind of study the industry that you want to trade with. You have to, you want to be also, having as much information as possible, how good Amazon is doing, how good Netflix is doing, how many subscriptions they have, how the business in general is doing. You want to have information. So my advice would be to pick just 4-5 stocks, be really good at them, and follow them. And when you follow, you're going to see what prices are to enter, what prices are to sell, when the market's going to publish the earnings. If there's a good number expected or there's a bad number expected, right? And also there is another way to trade stock, which is the IPOs. I don't know if you know about this, the initial public offerings. But here, of course, that your broker has to offer you the IPO, the initial public offering. So what that means is that you don't have any prices. When you trade an IPO, you have no prices whatsoever to measure your transaction with. You're basically trading blindly on the stock, and then there's no prices whatsoever. There's nothing on your chart. And then suddenly you have the tick, of course, is going to show up here. Let's say, I don't know, Hoover, right? So we have Hoover, we have Spotify, right? Those are the two hot IPOs for next week, for next year, Hoover and Spotify. This is music industry, and this is transportation, I guess. So, those two IPOs, your broker tells you they're going to offer the IPO of these two. So if the stock is going to start giving you prices, let's say at 9 a.m. or 10 a.m., it's not like a very specific time. It's supposed to be the first hour of the action on the trading floor. But it could happen earlier, it could happen later. And then when the IPO shows, most IPOs tend to spike up. Like it's been a pretty good IPOs trading with 30% over the price when they started it. Some IPOs are pretty bad, like Twitter, or let's say, Facebook didn't go that well on the IPO day. But let's say most IPOs, it goes up. Most IPOs tend to go up. So basically what you do is that your broker offers you the IPO, and then you have Hoover. You pull up the chart and then you buy 100 stocks. I don't know. And it keeps moving up for the first 40 minutes of the trading session. You keep buying. It keeps moving up for the next 30 minutes of the trading session. You buy 100%, 100 stocks more. And you keep doing so until noon. Because that's when everything happens. At noon, for the first 3 to 4 hours of the IPO to be in action in the market, that's when the truth comes out. If this is a good IPO, it's going to keep moving at those highs at noon. If it is a bad IPO, it's going to make you a drawdown. It's going to drop like 20%, maybe, 25%, something like that. And if it is a very terrible IPO, it's going to drop from the price that it started it. So you have all those scenarios. The best way I think it is to trade IPOs, I traded only the Alibaba IPO. That was back in 2016, this one. It was a big deal when it came out, the IPO. And it was also pretty good when it showed up in the stock market. So you start doing like this. You first have your price, you buy 100 stocks. You wait 30, 40 minutes, and then you buy 100 more. And it keeps moving up, and you keep buying more. Around noon, you decide if it starts consolidating the price and it doesn't go up anymore, you cash it. That's it. You grab that money in your pocket. And then you can keep buying more if it keeps moving up, right? But everything's going to be cooked on those 3 to 4 hours on the trading floor. And that's how you trade IPOs. So I give you, like I said, 3 different strategies. And of course, like I said, you have to also know what you're doing. I mean, you got to follow that stock. You can't just trade the gap like nothing happens. What if, you see a gap, you go to all different stocks, right? You go to Apple, you go to Disney, Netflix, Amazon, and then you see all those gaps, and you know what to do because you already know the strategy. You know exactly what to enter with, right? But then you were not following the news, and there was a huge strike on, employees of Alibaba in China, and it's like a big deal, or like a very important, sue on the company. So the stock is kind of not into an entry point, even though you have a pretty nice gap. But then you enter the market and they published something that was not good. And then that's when you start making bad decisions. So try to follow first the industry. Follow Netflix, follow Alibaba, follow Amazon, follow Microsoft, follow Apple. Know when Apple is going to launch new products. Just that's also the expectation of that product is going to push the price of the stock up. All right. So make your homework first, and the best tool for that is right here. This is all you need. The earning calendar. You go to investing.com, and here you got the all IPOs programmed for next year, all of them. You have the earning calendar right here. And then you have, here's a pretty good tool too, right? The open price, the closing price, the average day range, the 52-week range, and then the date of the earnings, right? That information helps you for both strategies, to trade the gap and also to trade the earning date. Right? And this is for your IPOs. And that's pretty much all you need to trade stocks. But of course, to start to study and to know more about the industry, more about what you're getting involved with. And for example, there's plenty of stocks now related to the marijuana business, because many countries are kind of, having regulations for that. So many laboratories, many, the lab industry, those stocks are kind of getting pretty good for the entry levels. So you may want to find out about that too. That industry, what's going to be next for the marijuana business, and in terms of medical issues and uses for because many other things are going to be also good for that specific regulation, and something that was prohibited for so long. Many things are going to happen for the next few years on the med side. So the lab and meds are a good industry to also find out what stocks are going to be related to that, and you want to follow those too, because blue chips are good, but they either split the price of the stock, or some traders and some investors, they're not going to be interested if it keeps moving up and up and up and up. So the market needs correction. The market needs to drop the price. Otherwise, no new money is going to start getting those stocks again. And that's a big deal for the entire, the finances in general.